All right, so joining us now is Jared Dillian. Jared, welcome to the show.
Thanks, man. Thanks for having me.
Yeah, listen. So we always invite our guests on to tell us what's on their mind, what's their favorite thing going on in the markets that they want to talk about. So, what did you? What's the biggest thing that you think is going on in the markets right now? One of your bigger themes that you want to discuss?
Man, what do you think is on my mind? It's like the bond market exploding higher, carrying out shorts on a stretcher. Uh,
That
that,
that's exactly what's going on.
that's what's going on. So listen, let's before we talk about like the trading and the macro aspect of this, let's think about this from the aspect of a retail investor. And what is the ideal portfolio, and how do people arrive at that? Most people are like 80-20, 70-30, but they don't really put a lot of thought into it. I took a survey, and 45% of people have 0 to 20% bonds in their portfolio. Um, and why not? Because stocks have gone up for like 11 years, and people don't really think too much about a bond allocation. And honestly, a lot of retail investors don't understand bonds, and you have this dynamic where financial advisors, if they underperform, they get in trouble and they get fired. So there's a lot of pressure, a lot of institutional pressure to keep people fully invested in equities. And when people look at bonds, they really think of them as a waste of time, especially now with tens around 1.8. Like why would I buy a 10-year note at 1.8? Why would I buy a 30-year bond at 2.4? And there's pretty good reasons, because once you get yields down to these levels, bonds really cross over from an income security into almost like an equity-like security. It's not equity, but it has different characteristics. And a lot of people don't understand the math behind that. If you've never taken a bond math class or really studied it, a lot of people think interest rates will go to zero and stop, or they think that bond prices go up linearly, but they don't understand convexity, and they don't understand that bond prices can go almost parabolic the lower that yields go. And bonds. Here's the thing I don't understand about people. Like they have these portfolios with 100% equities, and they're willing to invest in equities that are overvalued, but they are not willing to invest in bonds that are overvalued. They'll invest in overvalued stocks, but they won't invest in overvalued bonds. And you add bonds to your portfolio because they have risk diminishing characteristics. If you had a 35-65 portfolio, and by the way, that's the portfolio that the risk parity guys use, you have about two-thirds of the return with half the risk. Two-thirds of the return with half the risk. That is the portfolio that has the highest Sharpe ratio. You can tweak it even more. If you have a portfolio that's 35% bonds, 55% stocks, 3% commodities, 3% gold, and 4% REITs over the last 20 years, going back to 1999, that portfolio has the same return as an 80-20 portfolio with half the risk. So
Right.
people, go ahead.
Yeah, no, I'm just saying. Yeah, I'm just saying. Right. I mean, that's definitely been the case going backwards for sure.
Yeah,
Jared, it's
and
Kev here. One second, I just a quick question for you. That's because we've had a situation where bonds and stocks have been negatively correlated. Do you worry about that correlation breaking down?
yeah, absolutely. I worry about it all the time. I mean, it kind of keeps me up at night, because once that correlation breaks down, then you have this big regime change, and bonds no longer reduce the risk in your portfolio. So then you have to start thinking about other asset classes. Like my guess is that stock bond correlation will become positive when inflation picks up. And then you have to start looking at assets like commodities and real estate and stuff like that. But for the time being, that negative correlation exists, and you still have to have it in your portfolio.
Okay, so Jared, where are we going though? I mean, are you in that camp where interest rates are gravitating towards zero or even negative in the United States?
I think they're gravitating towards zero or negative globally. And honestly, I don't want to be too crude about it, but the biggest reason is Donald Trump. Absolutely. I mean, if Trump wanted stocks higher, he got stocks higher. Trump wanted interest rates lower. He got interest rates lower. The only thing he hasn't gotten his way on is the dollar, which is higher. But, Trump has intervened at the Fed over and over and over again. This rate cut was directly attributable to Trump. They'll get more rate cuts. The whole yield curve will come down. Hopefully it'll steepen. But yeah, I mean, this is a force that is affecting interest rates globally. I saw the other day that the Austrian 100-year is trading under 1% now, and everybody's like, "Oh, that's terrible." I'm like, I would buy it. Like, I would absolutely buy it. So.
Yeah, but you're buying it as a trader, though, right? Because it's not you can't really justify a buy and hold for the long term on that Austrian bond. I mean, you're just talking about the convexity and the fact that with the interest rates structurally going lower, you're still going to get more juice out of that century bond, right?
Yeah, I mean, but a lot of people they sort of get morally indignant about it. It's like a moral thing. Like, like I can't buy a 100-year bond with a 1% yield. It's just wrong. Like, it doesn't matter if it's wrong. Like,
that sounds like someone I do a podcast with.
It's going to go up. So, I mean, look, I'm pretty strident about this duration call, this lower interest rate call. I have been for a while. I have been since 3.25 and 10s. But I think it still continues to work. And, if you want to talk about inflation, there's still no inflation. I mean, all the macro stuff is there. So, from my standpoint, I'm not, to me, it's not like a fast money trade. I've just tilted my portfolio heavily towards bonds, changed the asset allocation, and it's worked out.
So, okay, now, obviously, many of our listeners are thinking, well, listen, why don't I follow the suit? We're going to buy bonds. We're all going to hold hands and sing Kumbaya. But the thing is that how does this play out, though? I mean, let's say the common narrative is we're about to see an economic recession. And we're going to, at some point, see the Fed have to go through a rate cut cycle. And so we're going to see a number of these cuts coming in. They're going to bring interest rates to zero on the front end. But we're going to see this whole thing pull back. And there's an opportunity to keep profiting from bonds. I love that story. I made that pitch. Kevin didn't like it so much. But that scenario I could see. But how long does this play out? I mean, is this bond story like a 1 to 3 year duration thing for you? Or do you still think that we're going to see this even for the next like half a decade or decade, that bonds are going to continue to work?
I mean, it's hard to say. I mean, I think if you asked a lot of people if bonds are currently in a bubble, they might say yes. I don't think they're in a bubble, but I think they will be in a bubble. And if you remember the George Soros quote, when he ever saw a bubble forming, he would get in there and make it bigger, right? So the question is, if this is a bubble or a bull market, what year is it? Is it 97? Is it 98? Is it 99? Is it 2000? If it's 97, then we have 3 more years. I don't really have a real strong view. I can't look out that far as to whether this is this big secular thing. We're going to have 10, 20 years of negative interest rates. But if it's 97, there's a lot of money to be made.
You know what? Kev, I have to say that Jared's a really smart man.
You two should. You guys should go out and just hold hands. But listen, you guys have been right, and so hats off to you because it's continued to go that way. I worry about it, but when you get something this overbought, but I kind of respect Jared's standing in there and saying nope, it's overbought, but it's probably going to still head higher. I've never thought about the fact that maybe retail is more underexposed to this asset class than I thought. It's actually a great insight.
Yeah, it's actually. I think retail is massively underexposed to fixed income. If you look at target date funds, these balance funds, if you know what a target date fund is, if you look at like a 2060 target date fund, it's 90% stocks. If you go to a robo-advisor and ask them for a conservative portfolio, they give you 86% stocks. My mom has her account at Edward Jones. This is a true story. The advisor comes up to me and he says, "We need to diversify your mother into aggressive growth stocks." She's a 73-year-old lady. The world is just absolutely choked on stocks. So, I mean, yeah.
Do you ever worry, though, that what they've done is gone into kind of bond surrogates in the stock market, like the XLU and a lot of the kind of, interest rate sensitive stocks might be overpriced? Like, do you worry that might be where the bubble is?
I don't know. That stuff is pretty small. I mean, if you look at the assets of like IYR and XLU and all the REIT ETFs and stuff like that, it's not that big. So I don't think so.
So what would give you pause that you would say, maybe I'm wrong? Like, what would be the signs? Like you said, if you saw inflation, what would be like? Wouldn't it be a situation where by the time we saw inflation, the bond market would already kind of backed up? Do you worry about that?
I don't know if inflation is going to be the catalyst. I mean, the FOMC meeting was super interesting. The one important takeaway from the FOMC meeting was that the yield curve 2s10s flattened 7 basis points. And by the way, the yield curve is not supposed to flatten when the Fed cuts rates. That's not supposed to happen.
For sure, it means they didn't. It means they didn't loosen as much as the market was expecting.
Yeah, that's absolutely what it means. And implicitly, it means that Trump is right. Now, I'm not saying he's right to like take away the Fed's independence, but in terms of his view on interest rates, he's absolutely correct. So if he's correct and the curve needs to steepen and the front end needs to come down, then it probably means we're going into recession. I see, I'm not worried about upside in yields at all in this environment.
So if they'd done 50, would you have been less inclined to buy the bond market? Like, would that be like I saw a guy on Bloomberg this morning, and one of the big kind of bond managers, and his whole argument was, I like bonds because the Fed isn't lowering rates quickly enough, and therefore it's not inflationary. So therefore they're going to be behind the curve, and we're going to get a continued flattening, and therefore I got to own the long end. Would you be worried if the Fed did come out and did 50 and said, by the way, we're also going to do QE? Like, what point would that scare you when they're easing too much?
I mean, you just have to watch the price action. I mean, if the curve steepened dramatically and it was actually like a twist, and the back end really sold off hard, then yeah, that would be an inflation trade, and you'd start to worry about duration. But we're just there's been zero sign of that at all.
So you're just watching the price action. You're saying this price action looks like it's headed a lot higher.
Yeah, absolutely. Yeah.
Wow. Yeah, and so one of the things you also mentioned is commodities. So is there specific commodities that you like or that you would include in your portfolio? And what would you put in if you did start to see an uptick in inflation and you wanted something to diversify your portfolio?
I mean, I don't mean to be like a metals bug. I think energy is a bit of a disaster. Ags are a bit of a disaster. I own an ETF that's a commodities basket, and I'm unhappy with it. I mean, honestly, if you want commodities exposure, I think you should just stick to metals, precious metals and base metals. And, I mean, see, here's the thing with precious metals that a lot of people don't understand. People say, well, gold's a terrible hedge against inflation. Well, gold doesn't really trade off inflation. Gold trades off the fear of inflation. Right, so if people are worried about inflation, then people buy gold, and that's what happened from 09 to 11. But we never got inflation. So it's really when people fear inflation. So when you see massive deficits that are going to have to get monetized, when you see people talking about MMT and people fear that sort of currency debasement type of inflation, that's when gold performs well. So.
Right.
But for now, you don't see any signs of that. This isn't enough. And so even though we're getting a situation where there's fiscal deficits, you're just looking at the price action. You're saying we're not there, so there's no point in owning those commodities?
No, I'm not saying that at all. I mean, I think that 10% of a portfolio should be commodities, and at this point in time, it should be metals. And the price action is pretty good. I mean, we're nowhere near like any kind of panic about inflation or currency debasement. That's very far off. But gold's up from 1050 to 1430, off the lows. Like that's, it's where I would call this the beginning of a bull market. So
yeah. So one of the things you mentioned actually is you said that Trump got his way with the Fed. He got his way with the stock market. The only thing he hasn't got his way with is the dollar. I completely agree, and one of my big themes that come going forward here is that I think it's only going to be a matter of time before he starts to talk down the dollar. And in fact, I'm worried he's going to do even more than talk down the dollar.
Yeah.
I'm worried he's actually going to do direct intervention.
Yeah.
And I was just wondering about your thoughts about that. Will he get the third pillar of his kind of? He gets the stock market, he gets the bond market, and will he get the dollar?
Yeah, it's a good question, and actually, that's kind of being talked about on trading desks. People are sort of anticipating the idea that we'll be doing currency intervention someday. I mean, there was a reporter that asked Larry Kudlow point blank, "Do we have a strong dollar policy?" And you know what his answer was? He said, "Well, we're not doing currency interventions, are we?" So I guess that's the definition of a strong dollar policy these days. We're not doing currency intervention.
Right. But don't you? But Jared, don't you think that Kudlow's out of the loop? And let's face it, does Trump listen to anyone? Like I don't buy that he listens to anyone. And I think that one day he's going to figure out that he can actually sell dollars. And he's gonna pull out the pink tickets. That's what I'm worried about. I think it's gonna happen. I think this guy, if there's one thing that you've learned from Trump, is to never underestimate the how much he's willing to do things that haven't been done before.
Yeah, I 100% agree. And, I don't think Kudlow really has any influence over it. By the way, I want to say, the timing of this podcast is pretty special. It's being recorded after this massive bond rally, and it sounds like a huge victory lap on my part, and I probably sound like a complete jackass. I just want to say, I'm a trader. I could get housed tomorrow, right? And we all have to have some humility, and I do have humility, and the trade has worked, and I like to talk about it. But gee whiz, a lot of luck is involved, and I'm just grateful that it's worked out.
So what's your call here? I mean, Powell comes out and basically literally said that this is a mid-cycle adjustment, and that giving the market the impression that this is a one and done. Is that a joke, or is?
Well, I think Powell actually believes that to be true. I think he genuinely believes that. I think that Powell is going to lose his job. I think Trump is going to get rid of him because they're going to come to an impasse here. The only way for Trump to get his way is to just get rid of Powell. So I guess I could make that call. I could say that's going to happen. Yeah.
So
I like it. I like it a lot, actually. I saw a guy on one of my trader feed guys. I get my Bloomberg chats, and he was taking markets predictions on what were the chances that Powell's key card was going to work the next day.
Yeah.
And I don't disagree with you at all. I think the market's probably underestimating the possibility that Trump gets rid of him. Quick question for you: what do you think happens if tomorrow he says Powell is demoted? And because I don't think he can fire him, I believe that all he can do is make him no longer the chair.
That's correct.
I'm not 100% sure. Okay, so what do you think happens, Jared? I'm going to put you on the spot here. What do you think happens if tomorrow he says he's no longer the chair? I put Neil Kashkari in charge of the whole thing and deal with it. What do you think the market does? The bond market, stock market, and dollar.
That's probably 4% down in the S&P. It's probably 3 full handles in the long bond. It's probably
up? You mean up? Like up?
Yeah, up. Yeah.
And the curve flattens, it goes inverted.
Yeah, probably. Well, actually, no. It would probably bull steepen. And gold would be up 40 or 50 for sure. Yeah.
So you think S&P would be down that much, though?
I really do. Yeah, I do.
I think I can see that.
Just because you think that the crisis in confidence of the fact that you have a president doing something so dramatic?
Yep.
And then, okay, next question. What happens a week later?
I don't know. Gee whiz, I can't. I mean,
does the stock market take it as good news, and do we end up higher after the initial sell-off is I guess what I'm asking.
I don't know. It probably depends on who the replacement Fed chair would be. I mean, it could be Kashkari, it could be Bullard, could be Judy Shelton if she ends up on the board of governors. It would be a dub. Yeah.
Yeah, if it was Judy Sheldon, geez, I can't imagine that. Okay, well, anyways, listen, for Jared, it's been a pleasure chatting with you. So why don't you tell people a little bit about yourself, what you do? You write a great letter. It's one of the letters that I subscribed to way in the day, and it's always a must read. So why don't people tell people about that, and also tell them about your new venture? You have you've given up podcasting and gone back to old school radio. Why don't you tell us a little bit about that?
Yeah, so my full-time job is I'm a publisher of the Daily Dirt Nap, which is a macro newsletter. And you should check it out. I'm at www.dailydirtnap.com. It's been around for 11 years, which is kind of a long time for a newsletter. Still going. You can find me on Twitter at Daily Dirt Nap. And yeah, the new thing is, I did the podcast for a couple years. It was successful, had a good time with it. I've shifted a little more towards personal finance. I'm starting the Jared Dillian show. It's going to be on terrestrial radio on FM. It's actually, we're still hammering out some final things, but it's supposed to start on Monday. And I think I'm going to start in Chicago and Las Vegas. But we're going to expand it to many, many other stations. And the goal is to sort of compete with Dave Ramsey and take a bite out of his business. So.
Well, that's great. You're going old school, going back a contrarian, going to the old FM radios. I love it. So Make sure you guys all go check out Jared on Twitter and thedailydirtnap.com. Thanks for being with us.